Good day, guys. Welcome to this YouTube class. If this is your first time on this channel, please click the red subscription button to subscribe to this YouTube channel so that when I drop more educative content, you get notified. So, in today's class, just like as I promised in my last class, I said I'm going to be solving a comprehensive question on transfer pricing, and that's what we'll be doing today. So, in my subsequent videos, we'll look at different angles pricing questions can come from and how we can attack them because it's very, very important to familiarize ourselves with how questions come. So we'll look at another one in my next class. So one thing I want you guys to know is that transfer pricing or topics like this are always the questions are always overwhelming. I mean, you see questions that's very, very, very long. You'll be thinking even that alone can even scare you off that you can't do it, but that's a lie. If you understand the process, the core principles behind it, you will solve it and you will even get it right self. So that's why I've taken my time to examine this very long question, but it's very, very, very simple. So follow me. Let's get to work. Benue Industries has several independent divisions. The company's tube manufacturers the company's tube manufactures a picture tube used in television sets. The division absorption costs income statement for last year, in which 8,000 tubes were sold, is given below. So we have the sales per unit and total. We have sales per unit 27,200,000 and per unit is 34. We have cost of goods sold, we have gross profit, selling and administration expenses, we have divisional net profits. So as shown above, it costs tube division 2,100 to produce a single tube. This figure consists of the following costs: direct materials 760, direct labor 540, production overhead 800, and 75% of this is fixed. So we have total cost per tube to be 2,100. The tube division asks fixed and selling administration expenses of 7 million naira per year. Benue Industries has just formed a new division called the TV division, that will assemble a TV set that requires a high resolution picture tube. The tube division has been asked to manufacture 2,500 of these tubes each year and sell them to TV division as one of the steps in determining the price that should be charged to TV division. The tube division has estimated the following cost for each of the new high resolution tubes: direct materials 8,200, direct labor 980, production overhead 1,080 naira, and 2/3 of it is fixed, giving us a total of 3,260. To manufacture the tube division would have to reduce production of its regular tubes by 3,000 units per year. There will be no variable selling and administration expenses on the intercompany business, and total fixed overhead costs will not change, assuming direct labor is a variable cost. Required: determine the lowest acceptable transfer price from the perspective of the tube for each of the new high resolution tubes. So here's the question. So if you see this question, you can see that it's very, very long, but it's still the same. We are going to apply the same principle we apply to short questions, the same principle we apply to this. The question is, when doing transfer pricing, if you want to get the minimum price that should be set, I explained something in my last class. There are two things that need to be considered, and those two things are: number one, the marginal cost, which is the variable cost of the transfer. That's number one thing we consider. And number two is you consider the opportunity cost of the transfer. So I've explained these two concepts in my last video class. I'm not going to be doing that here again to save our time. So in case you have not watched the video, I'll drop the link right under this one. Check it out so you understand the concept before you come to this kind of question. So now, the first thing I want to determine is to determine my marginal costs from this question. So how can I determine my marginal cost? Very simple. Let me go through the question. I will see some information. I will point out to the marginal cost for me, and I can see it right here, which says the tube division has estimated the following cost for each of the new high resolution tubes. So variable cost uh, is what comprises the marginal cost. So we need to, since this they have given us the breakdown of the cost, we now look for the variable cost. They said direct materials 8,200, direct labor 980, production overhead 8,080 naira, and 2/3 of it is fixed. Now there's something I need to tell you, is that whenever you are dealing with transfer pricing, if you are dealing with transfer pricing majorly, please, most times we don't consider fixed cost in making this decision. So there are some situations where you consider fixed cost. I think I explained that in my last class. So, but in this one, we don't need the fixed cost. All we need is just the variable cost, because in making decision, in fact, if you have not watched videos on marginal costing and absorption costing, I'll drop that link under here too. You need to understand that before coming to this. So, in making decision, the only cost we consider is the variable cost. Now, let's go. Let's highlight all the variable costs for producing the high resolution tube. Let me explain. We have a tube division and we have a TV division. So this tube division is going to be selling to TV division at is going to be selling 2,500 units of tube. It's going to be selling 2,500 units of tube to TV division. So we need to calculate the marginal cost of each of these 2,500 units of tube, which is the variable cost. So let's go. We are told that the direct materials of each tube will be 1,200. We're also told that the direct labor of each tube will be 980 naira. And we're told that the production overhead is 1,080 naira. But we're told that 2/3 of it is fixed. So if 2/3 of it is fixed, then definitely you accept with me that 1/3 of it is variable. So 1/3 of this of 1,080 naira is 360. If I do the calculation, 1 2 plus 980 plus 360, 2,540. This plus this plus this plus this. So I've gotten my marginal costs. Now the next thing I need to get is my opportunity cost. And how do I get that? I've already explained in my last class as well that opportunity cost is what you lost for you to be able to get another thing, or for you to be able to do another thing. Imagine I have the choice of either buying this book or buying this pen. So if I decide to buy this pen, then I'm foregoing this book for this pen. Then what I'm foregoing is my opportunity cost. So to calculate the opportunity cost, what is that thing tube division is foregoing? We need to estimate the cost of what tube division is losing to be able to supply this guy 2,500 higher quality of tubes. So let's go. In the question, there's a particular place that we're told that to manufacture the new tube, the tube division would have to reduce production of its regular tubes by 3,000 units per year. We're told that this tube division, this guy, at the beginning of the question, he produced 8,000 tubes per year. He produced 8,000 tubes, but now because he wants to supply to this guy, he has to reduce this by 3,000 tubes. So we need to calculate the contribution of this 3,000 tubes, because that is the amount this tube division will earn from this 3,000 units is what we need to calculate, and that will be his opportunity cost. So what is the amount this guy is losing for not producing that 3,000 units? So let's go. If you go back to the question, there's a particular point in the question where they give us the estimate of producing. This guy produced 8,000 units of tube, right? So they give us the breakdown of the costs of producing each tube. So let's go from the question. We're told that, as shown above, it costs the tube division 2,100 to produce a single tube. This figure consists of the following. So the cost of producing this guy's tube that is selling out to outsider. Let's go and calculate it. So we're told that we have direct materials. So direct materials, which is 760. We have direct labor, which is 540. So we are also told that there is production overhead. So they told us that production overhead is 800 and 75% of it is fixed. So if it's 75% of it is fixed, you accept with me that 25% of it is variable rather. 25% of 800 will give us 200. And if we add all these together, 760 plus 540 plus 200 will give us 1,500. So this is the cost of producing each tube that this guy is producing. Let's see if there are any other costs that we need to add it to this. That's the cost of this guy producing this. Let's see. So if you look at the question, okay, I think I can see one. In the question, they told us that in the estimate, they told us that selling and administration expenses is 7,800 or 7.8 million. Anyone, well, let's short it to just have something like 7,800. In the breakdown, we're told that selling and administration expenses is 7.8 million. Selling and administration expenses can be fixed and can be variable. So we're not told if it is rather fixed or variable. We're just told that it is 7.8. And then now continuing the question, there's a particular place that now told us again that The tube division has a fixed and administration expenses of 7 million. So this is the total selling and administration expenses. So it now has a fixed administration expenses of 7 million. So if this is the total and this is the fixed side, so tell me what is the variable? The variable is 800,000, right? So 800,000 is the variable fixed and selling administration expenses. Now, if 800,000 is the variable fixed and selling administration expenses, how many units did this guy produce for him to be able to have 800,000 fixed and administration expenses? It is 8,000, because from the estimate we were given before, we are told that this guy produces 8,000 units. So 800,000 variable for 8,000 units, then how much is per unit? So 800,000 divided by 8,000, 3 cancel 3, then 800 divided by 8, that's 100 naira. So that's 100 naira is this variable fixed selling and administration expenses per unit. So this is the direct material, direct labor, production overhead, plus this 100 naira will give us the total cost this guy spent in producing one tube that is selling to outsider before selling it to this guy. So let's go. Plus the 100 naira plus variable fixed and selling expenses. So which is 100 naira, that gives us 1,600. So this guy, which is the tube division, spent 1,600 to be able to produce this 3,000 units. You know, he said, don't forget that he says that this guy, this tube division, has to forgo 3,000 units. So this is the amount for producing 1 unit of the 3,000 units. So how much is he going to earn from it? If it is the cost, the amount is spent on producing 1 unit of the 3,000 units, right? So let's calculate how much it's going to make. And how do we calculate that? We are going to calculate it in form of contribution. Simply, sales contribution is simply sales minus variable cost. So contribution is equals to how much is the price is selling one. I've already gotten the variable cost to be 1,600. So from the question, we're given the amount he sells once. So we have been told in the question, we have been given sales is 3,400. That's sales per unit. So variable cost is 3,400 minus, sorry, sales is 3,400 minus variable cost, which is 1,600. So one contribution 800. So this is the contribution, the amount this guy will be earning on each unit of the 3,000 is losing. So if this is the single amount he'll be earning on one, then the question is, what's the total amount of money you will be earning on the 3,000 units? So to get the total amount of contribution you'll be earning on the 3,000 units, that will be 1,800 times 3,000, because from the question we've been told that he's losing 3,000 units, and this is the amount. We need to calculate the opportunity cost. This is the amount is losing on one. The amount is supposed to gain from each of the 3,000 units is 1,008. So what's the amount is going to gain from the 3,000 units? Is 1,008 times 3,000. So let's see what that amounts to. 5,400,000. So this is the total opportunity cost of this guy selling to of tube division selling to TV division, 5.4 million. But don't forget that we've been told that, I even wrote it here, that tube division only wants to sell, can only make 2,500 units and sell to tube division on to TV division, because he could not make the 3,000. Don't forget that what is losing to be able to produce this 2,500 is 3,000 units, but he could not produce that 3,000 units because he's producing a very high resolution. So these 2,500 units they have a very high resolution, very high quality. So now, if I want to charge this 2,005, this 5.4 million on these 2.5, because I cannot add this 5.4 million on one single unit, leaving others blank. No, I have to distribute this 5.4 million on these 2,500 evenly. So how am I going to do that? By saying 5.4 million, just divide it by 2,500. So I'll know additional amount I will charge on each unit of the 2,500 to be able to cover this 5.4. Because two things we need to consider: marginal cost, opportunity costs. So let's go. 2,160. So this is the extra amount I have to charge on each unit of the tube division, or of the high resolution division or tube, to be able to cover my 5.4 million opportunity cost. So since this is my marginal cost, and let me get my I've gotten my opportunity cost. So my opportunity cost is also 2,160. So if I add the two together, I will get the amount this guy should sell each unit of this product 4,700. So this is the amount subdivision should sell each of its units to TV division. You should sell it each of the amount 4,700. I hope you have a nice time. Please, if you have not subscribed to this channel, please do well to subscribe so that when we drop more educative content, you get notified. Thank you and see you in my next video class.